Good morning and welcome to our first video for 2019. First off, let's just recap what happened last year, because 2018 was a very negative year for a number of major stock indices. Here are some of the numbers. Last year the FTSE 100 was down 8.8%, S&P 500 down 4.4%, Euro Stoxx 50 down 12.1%, and worst of all, the Chinese Shenzhen Composite down 32%. And also these are total return figures, so they do also account for any dividends received during the year. So clearly a very negative year for markets. Still, there are lots of things worrying markets leading into this year, and three of those major issues are interest rates going up in the US, the trade war between the US and China, which is threatening to impact global growth, and last of all, Brexit. So investors are still focusing very closely on those three issues, and unsurprisingly, any hints of any resolution or any progress within those issues is leading to rises in markets. So over the last couple of weeks, there has been a lot of focus on those issues, and there has been a bit of volatility in global markets. So issue one is the rising interest rates in the US. Now last year the Federal Reserve did raise rates several times, and there was some concern they would just plough ahead with raising rates regardless of the impact on financial markets. Now when interest rates rise, that means it's more expensive for consumers to borrow. That leaves them with less disposable income, therefore demand in the economy goes down, and that's one of the reasons why the stock market fell last year. So investors had been concerned about the possibility of lots of further interest rate rises. However, it does now seem that the Federal Reserve is willing to consider the impact of its actions on global markets, and it does now seem that several future interest rate rises are becoming less likely. Here are some comments from the Federal Reserve's last meeting. So 2 points of interest here. The first was that they implied that at the moment US rates are fairly close to the neutral level, so that implies they don't really think that rates need to go up much more. And second of all, they did say that they are aware of the volatility in financial markets, and now their future policy is becoming less clear. So that means they're not really sure how many more rate rises will be required, but it does imply they won't be raising rates quickly, and that's definitely a good thing for markets. So last year it was expected there would be 4 rate rises in 2019. That expectation has now dropped to 2. So I think that probably is a positive for global markets, and when these minutes were released, global markets did rise. Second issue is the trade war between the US and China. And just to recap, at the moment, the US is imposing tariffs on approximately half of all the goods coming in from China. So those goods have a value of about $250 billion. Now, there were plans for the US to impose tariffs on virtually everything coming in from China, but that's been postponed because China has agreed to come to the negotiating table. And that in itself is good news, because when these tariffs were first imposed, China wouldn't even engage in talks with the US. However, these tariffs have really hurt their economy, as you can see by the fact that their stock market was down over 30% last year, and it's not surprising that they are perhaps considering a compromise. So it's important to note that as yet no formal progress has been agreed, but the mere fact that talks are taking place has definitely been taken as a positive by markets. And the final issue is Brexit. It's still completely up in the air. I'm not even going to try and predict what's going to happen next, but I have got some key dates here. So next week, on the 15th of January, we've got the meaningful vote, which is when MPs have to vote on whether to accept or reject the Brexit deal in its current form. If they reject it, Theresa May then just has 3 sitting days to propose a Plan B. So she would have to do that by the 21st of January. There's then not much time to implement a Plan B, because by the 29th of March we have to have left the EU. So Brexit timeline is now looking very tight, and the next 2 weeks will be crucial. So we'll be looking out for news very closely. Also next week, we've got a number of companies reporting as we move into earnings season, and what we'll be looking out for here is comments on forward guidance from chief executives, because in the last earnings season we did have a number of very good corporate results, but they were combined with comments from chief executives that implied they were quite worried about the trade war between the US and China. So we'll be looking for some updates on those comments. That's it from us. Have a great weekend, and we'll see you next Friday.